Today, we're diving into a company that is, without a doubt, right at the very heart of the AI revolution. I mean, its technology is so essential, it's basically the backbone of our AI future. But this company, Supermicrocomputer, is also facing a crisis of absolutely epic proportions. So how can an innovator that's so crucial to everything be teetering on the edge of collapse? Let's dig in. Okay, let's just start with this number, 66%. In a market where AI stocks have been just going to the moon, Supermicro, or SMCI, has watched its stock plummet a staggering 66% from its 52-week high. You know, this isn't just a little dip, this is a free fall. And that really brings us to the core question here, doesn't it? How can the company that's literally building the future of AI, a company whose tech is in such insane demand, be in this much trouble? It's a total paradox. And to really get it, we need to look at two very, very different sides of the same company. Yeah, the best way to think about SMCI right now is really as a tale of two companies. On one hand, you've got this technological titan with a dominant, almost untouchable position in the market. But on the other hand, you have a company that is just mired in this severe crisis of trust and governance. So let's break down both sides of the story, and we'll start with the bull case. So, the reason Wall Street absolutely fell in love with SMCI in the first place, it comes down to its technology, which is just completely dominant. This isn't just another server company, you guys. They have a real, powerful, and frankly, a deeply entrenched competitive advantage. And that advantage, it's built on this, direct liquid cooling, or DLC. The easiest way to think about it is like a high-performance radiator for a supercomputer. You see, as AI chips like NVIDIA's Blackwell get hotter and hotter and use more and more power, traditional air cooling just can't handle it anymore. Liquid cooling isn't a luxury, it's become an absolute necessity. And here's where it gets crazy. Look at how completely SMCI dominates this critical market. They control somewhere between 70 to 80% of the entire AI rack liquid cooling space. They were pioneers. They perfected this tech and integrated it while their competitors were honestly looking elsewhere. And the result? A near monopoly on a piece of the AI puzzle that everyone needs. So why is their tech so valuable? Well, it all comes down to efficiency, and that's measured by something called power usage effectiveness, or PUE. For data centers, this is the holy grail. It basically measures how much energy is actually going to the computers versus how much is just wasted on stuff like cooling. The closer that number gets to 1.0, the more efficient and way cheaper to run the whole operation is. And this just brilliantly shows the economic power of what SMCI has built. Their liquid cooling systems, they can slash power consumption by up to 40% and get a PUE as low as 1.06. I mean, for a massive data center, that translates into millions, and I mean millions of dollars in savings every single year. But it's not just about the cooling hardware itself. They've built their whole business model around speed. Their building block solutions are basically pre-configured, ready-to-go AI server racks. It's like a plug-and-play system for building an AI data center at an absolutely incredible pace. And here's the bottom line. It's all about time. In this race for AI dominance, getting the latest, most powerful chips up and running before anyone else is everything. And SMCI can deliver these fully integrated systems 3 to 6 months faster than giants like Dell or HPE. That speed, that is their ultimate edge. And hey, the results speak for themselves. In the second quarter of their 2024 fiscal year, revenue just exploded by 123% year over year. The demand is absolutely insane. So, with this incredible technology and this kind of growth, what on earth could possibly go wrong? Well, let's flip the coin and look at the other side of the story. Okay, this is where the story takes a really dark turn. Because for all its technological success, the company is facing what you could call a catastrophic failure in governance and trust, and it is tearing their financials apart. This slide right here, this captures the whole problem perfectly. While their revenue shot up over 123%, their gross margin, that's the actual profit they make on each sale, it collapsed by almost 46%. So think about that. They're selling more than ever before, but they're making far, far less money doing it. So where did all that profit just vanish? Well, first, there's an incredible dependency on a single customer who makes up 63% of their sales. That gives that one client huge leverage to demand steep price cuts. Second, to keep that speed advantage, they're paying a fortune for things like air freight, basically trading profit for speed. And third, the big guys, Dell and HPE, They're awake now, and they are slashing prices to compete, forcing SMCI into a really brutal price war.
But the financial problems, honestly, they're overshadowed by an even bigger crisis, a legal and ethical disaster. We're talking shareholder lawsuits alleging the company concealed a Department of Justice investigation for years, until the shocking details of an indictment were finally revealed on March 19, 2024.
And the allegation is just breathtaking. The DOJ indictment claims a conspiracy involving one of the company's own co-founders to illegally smuggle $2.5 billion worth of high-end AI servers to China. This goes so far beyond an accounting error. This is a crisis of integrity at the very highest level of the company. And on top of all that, you have their inventory. It has ballooned to over $10 billion. Now, the company will tell you this is a strategic move to meet demand, but it also represents a massive risk. In the fast-moving world of AI, those chips can become obsolete almost overnight, leaving them with billions in worthless stock. So we have two completely different stories, don't we? A tech champion and a company in total crisis. So how does an analyst even begin to make sense of all this? Let's take a look at the final verdict from the source material. It all really boils down to this conflict. The bull case, it's crystal clear. Amazing technology, explosive growth, and a monopolistic market share. The bear case is just as clear. Collapsing profits and a legal firestorm that honestly threatens the company's very existence.
And this whole conflict makes the valuation fascinating. If you use a metric called the PEG ratio, which compares a stock's price to its earnings growth, SMCI actually looks incredibly cheap. I mean, a PEG ratio of 0.42, that's the kind of number that gets value investors really excited. But, and this is the absolute key takeaway, that low price isn't a simple bargain. It includes what analysts call a governance discount. The market isn't dumb. It's pricing in the massive risk that this whole legal crisis could end in disaster. That cheap price is your compensation for taking on that risk.
So how are analysts thinking about managing this kind of risk? Well, the source report lays out a pretty disciplined framework. For entry, some are looking for a clear trend reversal, while others might just stagger their purchases. For an exit, one strategy is to sell half your position at the first sign of a bounce, just to get your initial investment back. And critically, a hard stop loss is seen as absolutely essential to protect your capital if the worst happens. Now, if, and it's a big if SMCI can actually survive its legal troubles and restore trust, the analyst consensus suggests a potential upside of 92% to their 12-month price target. It is a textbook example of a high-risk, high-reward gamble. Which leaves us with this one final thought. Super Microcomputer is building the physical hardware that makes the entire AI revolution possible. There is no doubt about their technological importance. The real question is, can a company that's building our future survive the demons of its own present?